Speaking of alternatives with Keshav Rajagopalan, Managing Director and Head of Product and Strategy at PGIM Multi-Asset Solutions. Incorporating alternative investments within multi-asset strategies involves a variety of considerations that go beyond basic asset allocation, such as liquidity and asset liability management. Keshav explores the world of managing multi-asset solutions with Alfred Lerman, Chief Investment Officer of PGIM Multi-Asset Solutions, and Mao Dong, Head of Portfolio Management at PGIM Multi-Asset Solutions.
I'm really excited about today's conversation where we're going to step back and talk about the role of alternatives in portfolio construction. I have two guests with me today who are my teammates, and I'm very excited to introduce and welcome Alfred Lerman, Chief Investment Officer of PGIM Multi-Asset Solutions, and Mao Dong, Co-Head of Portfolio Management at PGIM Multi-Asset Solutions to the podcast. Welcome, Alfred and Mao.
Thanks, Keshav. Happy to be here.
Likewise.
To get started, it'd be great to get to know a little bit more about you. What brought you into investment management and what gets you excited today? So, Alfred, maybe to you first.
Sure. I spent over 28 years in the industry, a majority of which I focused on asset liability management for insurance companies and pension plans. Started out as an actuary, spent time in consulting, followed by a number of years on Wall Street before coming to Pro. And now I've been here for about 17 years. I built a quant team in General Account's CIO organization. I ran Global Portfolio Strategy Group, and then became the CIO for two of Prudential's domestic insurance businesses, life insurance and annuities. And for the past 3 years, I've been serving as a CIO for PGIM Multi-Asset Solutions, leading our investment team, having direct responsibility for ALM, tactical, and strategic asset allocation, kind of across all flavors of public and private credit, structured assets, equity alternatives, and derivatives. In terms of what I enjoyed across my experiences, I would say what motivates me is ambiguity, fast pace, and complexity. And when it comes to portfolio management, one often has little choice in terms of the benchmark, whether it's a public index or insurance liability. So the asset side of the balance sheet becomes your primary toolkit. And optimizing the portfolio, taking into account varying risk and return objectives, constraints, regulatory and accounting impacts, that is what makes it fun for me.
And Mao, you're a relative new joiner to PGIM. What drew you to the PGIM platform and what excites you about what you're doing today?
Yeah, thanks, Keshav. My background is a bit more boring than Alfred's, but I spent almost 15 years in managing multi-asset portfolios. A bulk of that was at GSAM, where I co-led the portfolio management of the outsourced CIO portfolios. I think what excites me most about multi-asset investing is that there's no single portfolio that is ever built to be the same. And I guess in some way it appeals to the engineer part of me in that really for every client portfolio, it's a unique problem set. And so to be able to customize a portfolio to the unique objectives, long-term and short-term for our clients gets me excited. I'm excited to bring that passion to PGIM Multi-Asset Solutions and work alongside Alfred to build out the platform and hopefully build more customized portfolios for our clients. I'd say in recent years, what's been quite exciting to me and what I observed is that alternatives has become an increasingly prominent asset class in multi-asset portfolio settings. It used to be this very nebulous, mysterious asset class that only the largest investors can access. But really, we've seen that shift to a more broad-based, more accessible asset class. And that's also spurred a lot of innovations in the industry, which is exciting because it means then we can apply that to more client portfolios. I'm looking forward to what the market has to bring in and incorporating that into the broader portfolio context.
Well, thank you both for that. Mao, you didn't even touch on the fact that Alfred's even more interesting because he plays chess in his late night hours.
Alternative investments can have a role to play in the construction of multi-asset strategies, as they can bring highly differentiated aspects to a broader portfolio, allowing an investment manager more latitude to tailor the asset allocation to support optimal risk-adjusted returns, among other considerations.
Typically with this podcast, as many of our listeners know, is we like to dive into a specific strategy and focus on it from different angles. I think what's interesting about both of your roles and what we're talking about today is how do we put alternatives together? What do alternatives do in a portfolio? And that's really what we focus on at PGIM Multi-Asset Solutions. It is that solutioning and alternatives are going to be a more and more important focus area for all investors. So maybe Alfred, to start, 60 seconds. When you think about portfolio construction and the role of alts, what are some of the considerations you focus on? What are you hearing from clients? And if you could talk about equity alts versus credit as you think about the framing of this for us.
Broadly speaking, two primary reasons why investors go in for alternatives. One, return, and second, diversification. But you really have to look at debt and equity separately. Debt, whether it's traditional private placements, investment grade, below investment grade, mezzanine, direct lending, all sorts of flavors of ABF, infrastructure debt. Unlike equity, that offers some cash flow stability and predictability. So return comes from the illiquidity premium. Investors have to be willing to give up part of their portfolio to be essentially buy and hold. And there's, of course, a complexity premium. There are efficient ways of accessing the asset via structured solution, for example. And then, of course, diversification. Access to issuers who can or choose to only finance in private markets. Access to different types of cash-generating assets. I mentioned in asset-backed finance space, for example. Lots of reasons to go into private debt. And then equity, whether it's private equity, hedge funds, real estate, commodities, high return potential. So there's risk, price volatility, and variable cash flows, but it can be less sensitive to market stresses just given some of these assets are marked to model. And of course, there's diversification, lower correlation to credit, I would say in the lower teens, and good fit for investors with long duration liabilities, in particular, insurance companies and some pension plans.
We'll come back to the liability theme in a second, but you mentioned a lot of different tools in the alts portfolio, and we'll dig into that in just a bit. Mal, talk about the role of alternatives alongside other things. Nobody's 100% alternative, so what are the alts doing, both equity and credit, alongside more traditional public asset classes?
That's a great question, Keshav, and I'll echo a lot of what Alfred mentioned. But if we just take things back to the basics, private assets can play a complementary role to public markets across asset allocation because it has potentially return enhancing features as well as diversifying characteristics. If we kind of break down alternatives or in particular private markets into their respective buckets, as Alfred mentioned, private equity is aimed at delivering long-term growth and enhance absolute return, but it comes at the expense of greater lockup, longer time horizons, longer time to get your returns back. Private credit presents attractive source of income and commands a yield premium relative to public markets, especially today when investors are looking to search for yield and can potentially have lower sensitivity to interest rates, given most of the private credit strategies tend to be structured as floating rates. Private real assets can offer potential inflation mitigation and combination of income and long-term growth depending on the underlying exposures. Now, the overall strategic asset allocation to private markets and alternatives in general will depend on an investor's time horizon, risk appetite, liquidity needs. For instance, if we're looking at a return-focused institution such as an endowment that has a long-term perpetual focus, they may have a higher allocation to private equity, given they have longer-term time horizon to wear out any sort of volatility. But if we're looking at an institution like an insurance or pension where there are liabilities associated with that portfolio and there's liquidity needs, there's a tendency to be allocated more to income-oriented strategies like private credit that tend to have less illiquidity. That being said, it can still take a while to get return back. And so as we look at the overall spectrum of private or alternative assets, it really will depend on the investor's risk tolerance, time horizon, and their liquidity needs. And we can be dynamic about that too, in terms of ramping up to a long-term strategic asset allocation to alternatives, because it does take time to build up a diversified alternatives program. And so what do you do in the meantime to manage the key risk associated with alternatives? That's critical.
Alternative investments, by their nature, can be quite complex, and constructing a portfolio of alternatives can take a great deal of thought and consideration of a variety of elements, such as liquidity, tolerance for risk or volatility, as well as desired or targeted level of return.
Mal, we'll come back to your dynamic component in a second, but Alfred, talk a little bit about when you and the team are constructing portfolios, how are you thinking about that time horizon consideration that Mal mentioned? There's the liquidity constraints, but then with it also the risk constraints. Investors are obviously going into alts for higher return potential, but hopefully they're being compensated for that risk. So if you could talk a little bit about both the liquidity considerations and risk considerations that come into the portfolio construction process.
Sure. So within equity, it depends, right? You may have easier time liquidating your investment in a hedge fund or commodity index. But when it comes to private equity, real estate, you're in it for a long haul. There are, of course, secondary market opportunities, but they're limited and they're often expensive. So it's important to recognize you can't just turn on and off an allocation. You need to achieve a vintage diversification. And this will really allow your portfolio to develop a more stable cash flow stream. With respect to credit, kind of similar considerations. There's just so many more flavors to it. You can go shorter, whether it's high yield private placements, floating rate commercial mortgages, middle market loans, some flavors of ABF, or you can go longer, IG privates, commercial mortgages, infrastructure debt. Where you are in a capital stack, also it's easier to sell higher quality tranches as there's more institutional demand and investors are less constrained. In terms of risk, these assets are illiquid and investors have to be able to withstand the short-term price volatility. Some of that is mitigated by what I mentioned earlier, some of these assets being marked to model as opposed to being marked to public markets. But the real risk, reduction in expected cash flows, whether it's due to credit losses or just lower exit values. One of the things that mitigates this risk for the portfolio as a whole is just lower correlation between private and public assets, between credit and equity. So diversification still plays a key role in the portfolio construction.
So, Alfred, you mentioned this is a slower moving portfolio construction process. And Mao, you talked about this as well, the ramp up considerations. But there is a dynamic component to it, right? You all aren't just set it and forget it. So, yes, there's the strategic elements of a portfolio construction. But maybe, Mao, talk a little bit about the dynamism that can be involved. Yes, these are illiquid asset classes in many ways. But how do you think about overweights, underweights? And then what are you and the team thinking about right now in terms of portfolio positioning? Where are there opportunities?
That's a great question, Keshav. As you noted, you can be dynamic with private assets and alternatives in general. And because relative to a strategic asset allocation, it takes a while to build up an alternatives portfolio, in particular, private assets. And so where you're seeing interesting and attractive opportunities will depend on the macro environment because all assets go through a cycle. And so right now, as we look at the macro environment, which we think is supportive of greater deregulation, greater M&A activities, in general, greater deployment of assets, and also backed by a stretched valuations across public markets. We do like private markets quite a bit. In particular, there are two sub-asset classes, I'll call them, that we like. And private credit is one of them. And that's really driven by a convergence of multiple secular trends. First, really sound market fundamentals, pick up in M&A activities, as I mentioned, just the pullback of banks and just increasing demand for more flexible financing options has encouraged a lot of innovation in this space and both strategy as well as structure, and some of which Alfred mentioned. In particular, we do like areas such as direct lending, both in the middle market as well as upper market, as well as asset-backed finance, which is a growing asset class because of just the increasing demand for innovations in the private credit space and gives investors exposure to a number of diverse sectors such as consumer, renewable energy, fund finance, bank risk transfers, etc. That being said, any sort of private credit strategy we believe should be backed by rigorous and sound underwriting to help manage downside risk. The other areas that we really like are real estate. And we see that there's emerging value opportunities as the market reaches a bit of a cyclical trough. And while the office sector continues to face structural headwinds, we maintain conviction in a broad-based rebound across other property types. And it's really supported by a few kind of macro factors that I mentioned earlier. There's a moderating inflation trends, generally stabilizing fundamentals, strong cap rates, NOI growth. And so for institutional investors that are looking to position in this recovery sentiment, we actually think real estate debt can provide both spread premium as well as portfolio diversification benefits.
So clearly, as you kind of think about the toolkit and where you can migrate portfolios, that's the dynamic component, right? There's a breadth of opportunities to access, and then you and the team are thinking along the way, where do you lean into and lean out of? Realizing illiquidity is always a consideration, but there are ways to adjust a portfolio and continue to seek attractive risk-adjusted returns.
An added challenge in serving insurance companies as institutional investing clients is navigating regulatory issues and adhering to sound asset liability management practices.
In all of these episodes, we like to unpack a headline, and in this case, it's headlines, but it's a very common theme, and I don't think a week goes by without some article about insurance and private credit. So, Alfred, where are you seeing that trend of private credit and insurance? Mal also mentioned some of the structural changes underpinning that asset class in general as banks are stepping back, but what's the role insurers are playing now?
Private credit is a key part of an insurer's portfolio, but there's a lot of complexity that comes with it. That beyond having a good handle on return risk assumptions, what matters quite a bit is regulatory and accounting construct in which insurance companies operate. So it's important to understand, for example, how assets are treated in reserve calculations, what capital charges are assigned, what stresses regulators require insurers to pass. Is there an accounting mismatch between how the liability is valued or an asset? Are there tax considerations? Certain assets have to be seasoned before a non-US investor purchases them. And if yes, who warehouses and at what cost? It's important to have a holistic view, and one often needs a sophisticated modeling platform to reflect all these interactions. But I would just say at the end of the day, sound ALM is key. It just has to recognize the impact across the entire balance sheet.
This ties into, we typically get burning questions from the floor from our distribution teams. And I think they're also hearing from clients just about structural changes in markets because of that wall of insurance money that's moved into private credit. So Mal, coming to you, it's termed permanent capital. That's how a lot of alternative asset managers are thinking about insurance dollars just because of the long duration nature of a lot of these liabilities. What are the risks for other investors? What should people be considering and thinking about structurally in terms of this wall of private capital? Alfred mentioned ALM, asset liability management, but what else is top of mind?
I think for the broader investor base, as Alfred mentioned, and as you noted, there's this kind of almost a rush of demand into private capital. You hear this term used quite a bit, but stretching for yield and rush towards the bottom. And so the biggest concern is, one, in stretch for yield, that you go down in the capital stack and looking at riskier type of credit at the expense of providing attractive returns. And so again, it goes back to the point I highlighted earlier, that a rigorous underwriting process and risk management process is critical in determining the suitable strategies for our clients. Because at the end of the day, we want to make sure that these strategies are providing appropriate and attractive risk-adjusted return, not absolute return on a standalone basis.
So, Alfred, something we've talked about obviously at length is the portfolio construction process, how to think about an SAA, and now some of the dynamic components of overweights, underweights. A lot of the success here is also making sure you're partnered with the right asset managers in terms of the security selection. So when you're talking to the PGIM managers who are originating these assets, thinking about covenants and private credit, what are you asking them about to make sure that their underwriting standards and credit review processes and overall investment processes are up to snuff?
Well, one, we are in constant interaction with our managers. We need to have visibility into what's happening in our portfolio. We need to understand if there are any emerging risks, if there's any value that's on the horizon. And this is where our partners come to us and provide a lot of that input, which allows us to think about how to allocate that marginal dollar. And from the risk perspective, we need to make sure we understand the cash flows. If there's optionality, how is that optionality manifest itself in different stresses and different scenarios. So understanding the key features of the loans, of the products, and the solutions that our managers provide to borrowers is critical. Of course, the covenants, the structural protections that allow ultimately to reduce that expected losses is also critical. But maybe Mao, if you have any additional thoughts, I'll turn it to you.
Yeah, I echo everything you said. I'd say when we look at what a successful manager should be doing at the inception of a mandate, they should be, one, able to demonstrate that they understand the underlying loans and credit, because these are not individual QSIPs that you can look up in Bloomberg, obviously, and price mark to market. And so understand the industry in which the issuers are reside and the borrower reside, as well as the trends and the underlying characteristics of the loan, having strong covenants in place and protection for the end investors. Those are critical elements of a strong portfolio. Then no one can predict what happens in the world. And so should there be any sort of impairments, defaults, we want our managers to come to us in a timely manner and identify those and talk about ways to work out that situation, ways to manage downside risk. And so having a sound track record of going through workout situations is critical. And on behalf of our client, we tend to also look at managers that have demonstrated track record of doing that. And so when you're looking at vintages, investing in initial vintages, there obviously needs to be a extra pair of eyes to make sure that the managers know what they're doing. But if they've demonstrated track record through multiple vintages, that at least will give us a sense that this manager has experience running a strategy like this. And so risk management is critical in investing in alternatives and private markets in particular.
Alfred, Mal, it's been a terrific conversation, obviously covered a lot of ground. I think three things that stood out to me just as I step back and think about where we went today. One is in portfolio construction with alts, strategic and dynamic are two different elements. So you set a strategic asset allocation, but there are always opportunities to be dynamic, even with alts that tend to be illiquid. Two is there's just different risk considerations when you bring alts into portfolio construction. You have to think about illiquidity. You have to think about ramp up. You have to think about how volatility may affect things. And Alfred, you made the point of mark to model versus mark to market. And then the third consideration is alts are really an expanding and pretty wide toolkit. So you have to really dig under the hood to understand what is in real estate debt versus private credit versus ABF versus private equity, because they're not all created equal and all very different. But Mal, Alfred, really enjoyed the conversation today. So thanks for taking the time to join me.
Thanks for having us on.
Today's conversation perfectly tees up our next episode, where we'll dive deeper into the topic of insurance and asset management and the nexus forming at the center of that. In September of 2023, Prudential, along with Warburg Pincus, launched Prismic, a reinsurance platform backed by third-party capital. In the next episode, I'll be joined by Nandini Mongia, Group CEO of Prismic, and Michael Thompson, Managing Director at Warburg Pincus, to talk about that nexus of insurance and asset management and all the exciting things happening there.
Speaking of Alternatives with Keshav Rajakapalan, a podcast from PGIM. Follow, subscribe, and if you like what you hear, go ahead and give us a review. And be sure to look for the podcast, The Outthinking Investor, also from PGIM. This podcast is intended solely for professional investor use. Past performance is not a guarantee of future results. All investments involve risk, including the loss of capital. PGIM is not acting as your fiduciary. The contents are for informational purposes only, are based on information available when created, and are subject to change. It is not intended as investment, legal, or tax advice and does not consider our recipients' financial objectives. This podcast includes the views and opinions of the authors and may not reflect PGIM's views. PGIM and its related entities may make investment decisions that are inconsistent with the views expressed herein. This podcast should not be reproduced without PGIM's prior written consent. No liability is accepted for any direct, indirect, or consequential loss that may arise from any use of the information contained in or derived from this podcast. This material is not for distribution to any recipient located in any jurisdiction where such distribution is unlawful. PGIM is the global asset management business of Prudential Financial Incorporated, which is not affiliated in any manner with Prudential plc, incorporated in the United Kingdom, or with Prudential Assurance Company, a subsidiary of M&G plc, incorporated in the United Kingdom. Copyright 2024. The PGIM logo and the rock symbols are service marks of PGIM's parent and its related entities, registered in many jurisdictions worldwide.